In today's market, with stocks all over the place and bond yields at rock bottom, where do you even look for stable, predictable growth? It's the big question, right? Well, in this explainer, we're going to dive deep into one potential answer, the ASK Private Credit Funds Series B. We're going to unpack their investment deck and see exactly how this thing works and what might make it a pretty compelling alternative.
So here's our game plan. We'll kick things off with a big picture. Why this corner of the market even exists. Then we'll zoom right in on ASK's new fund, take a peek at how its predecessor performed, and really get into the nuts and bolts of their strategy. And we'll wrap it all up with the fine print for investors, which is always super important. Let's get to it.
Okay, first up, the why. Before we can really get our heads around this specific fund, we need to understand the core problem it's trying to solve for investors in the first place.
This right here is the fundamental challenge, isn't it? How do you actually grow your money without just throwing it out there and hoping for the best against every market shock? It's all about finding that sweet spot between playing offense, seeking those good returns, and playing defense for your portfolio.
And, for a growing number of investors, the answer is something called private credit. The easiest way to think about it is this. These funds basically act like specialized lenders. They step in to provide smart, customized financing to great companies that, for whatever reason, can't get what they need from a traditional bank. They're filling a really crucial gap in the market.
All right, so with that foundation in place, let's turn our attention to the main event of this explainer, the ASK Private Credit Fund Series B.
Now, the very first thing you need to know about the ASK Group is the heavyweight in its corner. This isn't some scrappy startup. We're talking about a firm that's backed by some serious institutional power.
And that giant is Blackstone. ASK Group is one of their portfolio companies, which, frankly, is a massive signal of credibility. Being part of the Blackstone ecosystem isn't just about money. It's about access to a global network, incredible expertise, and a whole different level of operational excellence.
And yep, that's trillion with a T. When you're talking about a firm managing over $1.3 trillion, you're in a completely different league. That number represents a level of institutional rigor, governance, and global market insight that's really second to none. It's basically a world-class stamp of quality.
So what's the fund actually look like? Well, it's a significant, regulated fund aiming to raise over 1,000 crore rupees. It's not some forever fund. It has a set lifespan, a tenor of about 5.5 years. And they've got a clear 2-year window, what they call the deployment period, to go out, find the right companies, and put your capital to work.
Now, what's really crucial here is that Series B isn't their first rodeo. Not at all. It's building on a model that's already been proven. So let's rewind and take a look at its predecessor, Series A, to see how this strategy actually performs out in the wild.
And the numbers from Series A, well, they're pretty impressive. It delivered a 15% gross IRR. That's the annualized return before any fees. They were also super efficient, getting 3/4 of the money invested in just 14 months. And super important, the money is already coming back. They've already distributed over 6% of the fund back to their investors.
So where did that money actually go? This is where it gets really interesting. They're not funding moonshots. They backed India's largest private airport operator. I mean, think about that. It's essential infrastructure. It's a business with incredibly stable, predictable cash flows that aren't tied to the latest market craze.
They also balance the portfolio with what you'd call defensive, non-cyclical plays. For example, they provided capital to the country's second largest pharmacy chain. That's a business people need whether the economy is booming or busting.
And they're not just playing defense, they're investing in the future too. By backing one of India's top 3 renewable energy developers, they're tapping right into the massive global shift to a sustainable economy. So you can start to see the pattern here. They target market leaders in essential, high-growth sectors.
So what's the playbook for Series B then? Well, it's not some radical new experiment. They're basically doubling down on the same disciplined, successful approach that worked so well for them in Series A.
Their investment philosophy is just crystal clear. On the left, you see what they look for: established, profitable businesses run by reputable promoters. And on the right, you see what they avoid: the really high-risk worlds of venture startups and trying to fix broken companies. This is all about backing proven winners, not betting on long shots.
And what underpins this entire strategy is an obsession with protecting capital. For them, it's all about structuring the deal smartly to minimize risk from the very beginning. That means getting hard assets as collateral and ring-fencing them so they can only be used to pay back the loan. It means making sure the company's day-to-day cash flow can easily cover the payments. And, this is key, they have a crystal clear plan for getting their money back before they even sign the check.
So how do they enforce all this discipline?
through an incredibly rigorous, multi-stage due diligence process. As you can see, this isn't a quick glance. It starts with a high-level review, then they bring in outside experts to tear apart the business plan. After that, they're on the phone, doing background checks with customers and suppliers. And only if a deal survives all of that does it finally face a two-tiered investment committee. It's a gauntlet designed to weed out everything but the absolute best opportunities.
All right, finally, let's talk about the terms, because this is where Series B introduces a really significant, investor-friendly change from its predecessor.
And here it is, the single biggest change. Just look at this slide. Series A had a pretty standard model, a management fee to run the fund, plus a performance fee, which is a cut of the profits. For Series B, they've completely scrapped the performance fee. This is a huge deal. It fundamentally changes the alignment. The manager's job is simply to deliver the target return, safely and predictably, not to go chasing extra risk to get a bigger slice of the pie for themselves.
This table just lays it all out, side by side. The strategy and the target returns, almost identical to the successful Series A. The radical difference is that fee structure. By moving to a management fee-only model, the goal becomes super simple. Maximize the actual net return that you, the investor, get to keep in your pocket.
And this quote really just boils their entire pitch down, doesn't it? Zero setup costs, zero performance fees, just a clear, best-in-class management fee. The value proposition here couldn't be simpler or more transparent. We're putting your interests first.
And that leaves us with a final, really interesting question. For decades, the whole two-part fee model, management plus performance, has just been the standard. By scrapping the performance fee, is ASK just trying to be competitive, or are they signaling a much bigger shift? Could this hyper-transparent investor-first model be the future? It's a fascinating development and definitely one to watch.